Best ever listeners, how you doing? Welcome to the best real estate investing advice ever show. I'm Joe Fairless. This is the world's longest running daily real estate investing podcast. We only talk about the best advice ever. We don't get into any of that fluffy stuff. And it's Friday. It's Follow Along Friday. And with Follow Along Friday, as you probably already know, because you're a loyal best ever listener, we talk about what we got going on so that we can apply those lessons we've learned to help you out. I mean, that's the whole name of the game, helping you out in whatever you're doing as a real estate entrepreneur. Got with us Theo Hicks, like we always do on Fridays. How you doing, my friend?
I'm doing good, Joe. How you doing?
I'm doing well and looking forward to our talk, our catch up, and ultimately helping out the listeners. So you want to give some updates?
Yep. So last week I underwrote my first deal, first apartment syndication deal. And
really? Your first? I thought you've been underwriting deals.
for my particular business. So
Well,
I've underwritten other deals before.
What about that one you were talking about before where you visited it and it didn't, it was local, it was uglier than you thought it was?
Yeah, you're right. This is the second one then, the second one.
So you officially just lied to everyone.
I officially misremembered everyone, yeah.
Okay.
So it was the second deal that I fully underwrote. And when I mean fully underwrote, I mean I actually do the financial model and then I actually visit the properties in person and I visit all the comps too. And so it was a property, it wasn't actually in Tampa technically, it was in St. Pete, which is like an island off of Tampa. And I just want to go over a couple of takeaways that I had when I visited the comps, because I was really excited about this property because pictures look great and the property looked really nice. The numbers made sense based off of the comps that they used, but I just had to confirm that there were actually comps. And in my opinion, I don't think they were, and I'll kind of go over why I think that, and you can let me know if you think otherwise, but I'm pretty sure we'll be in agreement. So the three three categories that I broke it down to was the kind of the surrounding area. Mm-hmm. And then that was number one. Number two would be the actual demographic on site, walking within and then kind of around the community. Because I went on a Saturday, so everyone's home, everyone's walking around, and the streets are busy surrounding the property. Then also the property type, and that is I'll go over what all three of those mean in a second. So the areas were different. So we drove to all the comps first, just because that's kind of how our trip took us. And the areas were really
who's we?
Me and my wife.
Okay,
me and my wife.
Got it.
And we drive to the first comp. It's got these really nice brand new office buildings surrounding it, and multiple low-rise apartment communities that are similar level to this comp. Then we drive in, then it literally looked like a resort. Like I felt like I was at Disney, and that's kind of the similar experience I had for all of the. I think we went to four or five comps in total, mm-hmm. And they all had that same feel to it. They were all 5-6 stories tall. Built in the 2000s. Surrounding area had a lot of new retail. So not even just like the existence of retail, but newer buildings with the retail in it. So an area that was developed. Actually, two of them had a dog racing track in front of it. So Marcelo didn't really like that much. And then we go to the subject property, and it's right off the highway, which is good. But then we drove in the back, and you can literally see the highway from the back of the property, and it was really, really loud. So that probably needed to be addressed. But it was surrounded by hotels, and the only retail I could find within like a mile radius with a Cracker Barrel. So that was a little bit different than I expected. And so, in my opinion, the areas were not similar enough for those comps that we looked at to be comps. The areas were too dissimilar. There wasn't enough retail and businesses in places for the residents to go surrounding the area.
How close were they to the subject property?
4 or 5 miles.
Okay.
There were no apartments surrounding this. There was no apartments of this size. It was between 250 units. Mm-hmm. There was no apartment of that size within like a 4-mile radius of this property, which is why they went out that far. So the areas was kind of like, okay, these areas are a little bit different. The demographics, similarly, the people that were walking around the comp properties looked more like young professionals, the people that just graduated college. not really any family, just kind of people like, just it looked like people like us, like our age. Whereas at this, so I'd say, maybe white collar, whereas other property, the demographic was blue collar, which I'm sure if you actually updated the units, you could attract that. But I was just concerned about the actual demographic of the area, and are there enough of the white collar workers to attract for that property to attract. So that's something I needed to look into. But the third category is why I disqualified them, because all the comps were low rise, like those 5-6 story apartment buildings. And then the subject property was a garden style. So it was just like a regular 2-story apartment building. And so the expenses are going to be different. The type of tenant you're going to attract is going to be different. They're just two completely different property types. Mm-hmm. So I guess the lessons that I learned was, number one, those are some things to kind of look out for when you're driving to the comps. And just to reiterate, don't just trust the broker's comps. Actually go to the properties, or at least, as Joe mentioned last week's episode, look at them on Google Maps just to at least give you an idea. But then also they need to be the same property type, which is something I could have noticed when by actually looking at the comp pictures. But I just didn't really look. I didn't really investigate it that much because I wanted to drive the market anyways. And so I realized that if you're looking at a garden style apartment, which is the 1, 2, or 3-story buildings, you should probably be comping other garden style apartments and not the low rise or high rise buildings.
And when you're looking at comps, you're looking at it from a rent standpoint, like how much rent you can command relative to other comps. Is that correct?
Yeah.
So why does it matter if it's garden style versus a low rise or mid rise building?
Well, the reason why I even discovered that distinction is because I was trying to figure out a way to have a better understanding of what the expenses would be for the Tampa area. Mm-hmm. And I was kind of doing some investigations, and they actually have this report, and this is another update I was going to give, but I'll go over it now. It's called IRET, mm-hmm. And they basically survey apartment owners, property management companies, and all the major MSAs. I think they do like 140 MSAs. And they ask them, essentially what their income and expenses are. And so line item by line item. So for income, what's your rental income? What's the vacancy, loss of lease, concessions, all those line items. Then for operating expenses, what's your maintenance and repairs, taxes, insurance, contract services, things like that. And when I was looking into that, they break it apart by the low rise and the garden style, and then I think the other one was high rise. And all the numbers were different for those three. And so that's why I was thinking maybe that's because there's a different demand for the low rise versus garden style. I mean, obviously I understand the expenses part, but I was kind of confused, or I guess taken aback by the rental income, because I assumed the same thing as you. But when I was looking at kind of comparing the incomes on that report, they were different, which made me assume that the rents were different. It was by a per unit basis and by a dollar per square foot basis, and then a percentage. And then all the other things were a percentage of the gross. They call it gross potential income, I think. But so that, I mean, aside from kind of my comp thing, that was an update I wanted to give. That if you're looking to figure out what the market rates are for the high and the low and medium range for your market, that's a good report to download. It's not free. It's like $500, but I think it's gonna be very helpful. But
and what do you Google for that?
I googled IRET income and expense reports, but the website is irem.org.
Cool.
So it's actually IREM, not IRET. Mm-hmm. So irem.org. You'll be able to find those income and expense for all the different commercial types. So they have for office, retail, everything. But yeah, so that's why I figured there'd be a difference, but I wanted to bring it up on Fall on Friday to see if you had a different opinion, and if you thought, what does it matter if it's a low rise, high rise? Just matters what amenities are offered and what the units look like in the area, of course.
Yeah, I haven't bought anything other than garden style, so I don't know. So I'm glad that you talked about this. And as Ashcroft Capital continues to evolve, we might start buying some mid-rise, low-rise, mid-rise buildings. I think it depends on the area too. Dallas, Fort Worth, I mean, there's not a whole lot of those relative to garden style, but I feel like in the coastal cities there are. So if we expand to more coastal cities, then we might come across more of those.
Yeah. So those are just the kind of the things that I looked at. I'm going to do the same thing this week. I'm actually underwriting 3 deals right now.
Wow.
So I need to pick 2 to visit, one on Saturday, one on Sunday. Maybe we'll hit 2 on Saturday. I'm not really sure. But yeah, so one of them again is in St. Pete, and then another one is in northern Tampa. Another one's by that property I talked about last week that I misremembered. So that'll be good because I'll get a double hit that area again. And really the main thing I'm trying to do is just get a better feel for the market. So just driving around, and on the way there, while you're kind of driving around the area, you get a really good understanding of kind of the vibe and the feel of it that you can't get otherwise. And so, and it's kind of just good to drive around and get out of the house. So,
and you already have a head start with the one of the properties because it's near the property that you already looked at. So you got a sense of that area. Cool.
And I guess one other thing too that I learned yesterday. So as I mentioned maybe a couple episodes ago, me and my business partner kind of separated our duties a lot more. So I'm focusing on finding the deals, underwriting the deals, and I'll be doing the asset management, whereas he's focusing fully on raising capital. So building a brand, talking to investors. And he yesterday so his goal is to talk to maybe like a handful of investors every day. And yesterday he talked to an investor who had a net worth above $15 million and the ability to raise $5 million in capital for deals. And I need to follow up and say, did he say that he's willing to do that, or is that what he's able to do? Because those are 2 different things. But regardless, that was some good news because
that's great.
The types of properties we're looking at are the 100 units or more, and so it's going to be $5 million or more equity raise. Mm-hmm. So we're really excited about that. That was really good news. And so now, it feels a lot different underwriting these deals now because now it's real. Whereas before I'm just like, well, I'm practicing on these bigger ones until we either get the capital or so that in the future when we have the capital, I can, be prepared. But now, it's looking like we're going to be able to take down a deal over 100 units. So that's really exciting.
You're growing into your vision, and that's the key. You had the vision, and you were taking action on it, and lo and behold, now you all are speaking to people who can help you realize that vision. But if you didn't have that vision to begin with, then you likely wouldn't have put yourself in that position to have those relationships and conversations about what you're doing. And I think it brings up an interesting point because I know some people who have a very small portfolio, but they talk about, partnering with hedge funds and family offices and people with $500 million net worth on, $50 million deals. And I believe sometimes the vision, if it's quite frankly unrealistic or not likely, it can hinder you, be a hindrance to your progression because people can be so focused on getting the one big deal and fast forwarding from a very small portfolio to a $50-60 million project. I mean, there's usually a couple steps in between at minimum. And sometimes having that big vision, with that big vision, if you just focus on that, you're missing out on the steps in between that can get you there. And then you don't end up doing anything. Mm-hmm. So I believe with your vision, it's a more realistic, it is a very realistic vision where, hey, I got a small portfolio. and or large portfolio, depending on how you think about it. Well, how many units you got? 12, 13?
13, yeah, 13.
13. Okay, so you have a 13 unit portfolio. I'll just call it that. And now I want to get into larger stuff, and I will get into larger stuff with 200, 250 unit property, one property. That's doable. And that's a good segue from a 13 unit portfolio versus if you said, hey, I want to go find a $50-60 million property, and which, by the way, a 250 unit could be a $60 million property, but that's not what you're looking for. And it's just it's a good way to think about things. And I do know people who have the grander vision, and it's good to have the grander vision, but at the same time, it can make you miss out on opportunities that can actually get you there faster if you did take those smaller opportunities.
Yeah, I actually was talking about this. I recorded the syndication school episodes that are airing next week. So if you're listening to this now, they're not out yet. They'll be coming out next week. But it was kind of about that. It's about having that grand vision, but you can't just have that. And then at the same time, you just can't have like a 1-year goal and that's it. You need to kind of bring those together, have your grand vision, and be like, all right, what can I do this year to get me one step closer to that grand vision? Not what can I do this year to get that grand vision. It's what can I do to get myself closer to that grand vision. So you put it really succinctly. And I mean, of course, I've got a vision of owning a ton of apartments, but I realize that I'm not gonna have 2,000 units in 6 months, right? It starts with one deal first. So I'm focusing on that one deal, but at the same time making sure that at the same time I'm also creating skills and kind of learning things that will help me get to that grand vision. So kind of making sure that I'm covering both at once. But I totally agree. If I was focusing on buying only a $50-60 million, 400 unit property, then I'd probably be underwriting deals for a while. Whereas now I'm just like, if I find a 100 unit property that meets my criteria, I'll take it down for sure.
Yep. Yeah. And also one way that manifests itself with having a much larger vision than that where it becomes actually a hindrance is thinking about how much you in that 12-month goal that you mentioned, how much that you want to make within those 12 months. A lot of times when I talk to people, they list out an amount that they want to make within 12 months when they're getting started in syndication as the same amount or greater than what they're making currently in their full-time job. And it's a little unfair to apartment syndication to have that goal. It's possible, by the way, but it's also a little unfair to apartment syndication to have the goal that in 1 year you're going to replace the income of your full-time job, because how many years in your life have you spent honing skills to earn the salary that you're currently making in the full-time job? Probably longer than a year is my guess. Probably 5 years, 10 years, maybe even longer.
Mm-hmm.
And when we have goals that, okay, I want to replace the income in 12 months, I love the ambition, but perhaps that ambition will be a negative, or perhaps that vision, the grand vision, will be a negative, because if you don't achieve the replacement of the income, then perhaps you won't have the motivation and inspiration to continue. And I can tell you, if you do continue, do consistent action, you do things like, you talk about in syndication school and on this podcast and in our book and all that other stuff, you're going to replace your income in multiples. I mean, five years ago, I think 5 years ago, I think about 5.5 years ago, I was leaving my full-time job in advertising. And, I don't know how many times, but at least 30 times I make more. I haven't even done the math, but a whole lot more in multiples than what I was making in my full-time job. But it didn't happen in 12 months. And it doesn't happen. Usually it doesn't happen when you want it to happen in the time frame you want it to happen. So it's just important. Takeaway is have a vision, but know that it needs to be as realistic as possible so that you don't get discouraged when you don't achieve it, and you don't miss out on opportunities that can incrementally get you there actually faster if you take those opportunities than if you pass on those opportunities waiting for the golden goose.
Mm-hmm. I think, using the example of the quitting the job is perfect because, you see that, I bet the most common post on Bigger Pockets is someone who's just starting out in real estate and they want to replace their income with their full-time job. And, I always wanted to respond every single time, oh, yes, it's totally possible. And if you put your mind to it, it's going to happen, but it's not going to happen as fast as you want it to happen. And if you're already, discontent in your full-time job, understand that you're going to be there for, another 12 months to at least 12 months before you're even able to entertain the idea of leaving. So just kind of understand that. And, I don't say that to kind of zap people's motivation, but to kind of to hopefully inspire them and have them think longer term and think, in terms of decades, as we say, instead of the next couple of months. So yeah, those are all great points, Joe.
Yeah. And it is possible to do it within 12 months, but if that's what you're banking on, then it can be a letdown. And that goes back to 50-50 goals that we've talked about before. Yep. 50% of the goal is achieving the goal, and then 50% is actually understanding the skills that you have acquired during that period of time where you've been attempting to achieve the goal. And regardless if you did or didn't, at least you have those new skills that you've honed and acquired so you can apply that to future stuff.
Yep, exactly. All right, so those are my updates. What about you, Joe?
I've been focused on personal development and some specific things I'm doing real quick. One, Colleen, my wife, and I went to a CPR class. So I know I can now, if you start choking, I can do the Heimlich. And if you have some sort of cardiac arrest, I can do CPR. So that's important, especially since we're going to have a kid in about, between today and 2-3 weeks from now. So I know baby CPR too, basically the same thing, but use 2 little fingers instead of instead of your whole hand. Plus you blow into their mouth. You cover their nose and mouth with your mouth whenever you're giving the 2 breaths. Certainly, if you're interested in CPR, go Google it. Don't just do exactly what I just said. And then, so one, we did CPR, learn that. 2, and this is all this past week, by the way. 2, I finally solved the riddle that is waking up with inspirational video or inspirational music and speeches rather. I couldn't figure out how to do it through Sonos until I looked at Spotify, which is connected to my Sonos speakers, and Spotify has Jim Rohn, ROHN, tracks. And so now I simply set the alarm for to wake up to Jim Rohn. And, there's probably others too. But one cool thing about what I found on Spotify when I searched Jim Rohn is that some people have mixed his speeches with music. And so it's waking up to like a jazzy Jim Rohn speech, which is pretty interesting. And Colleen approves, which is important too. So that's good. So we can wake up to that and did this morning. That's 2. 3 is started to date I've completed 12 books for the year, which is kind of weak sauce. So I'm going to put a more concerted effort into reading. Completed a book this past week. It was a fun book, Leverage in Death by J.D. Robb. So it's like a thriller, like a spy thriller. So not necessarily work related, but Tim Ferriss would say it is actually more beneficial to read fiction books than nonfiction from a business standpoint because it expands your mind, helps you think about different things, gets your creative juices flowing, that sort of stuff. So nonetheless, finished that book. Now I'm reading a book that I won't tell you about yet because I'm going to actually apply the principles in the book for at least a month. I've already started, and then we'll talk in a month or two about the results of that book. And then lastly,
Before we move on, what part of the day do you read? I'm just curious.
uh, it varies. Well, if I wish I wanted something, I would just schedule it and I figure it out. So I guess I shouldn't say I wish I did it, but it would be more ideal if I did it in the morning every time. But it, I do it sometimes in the morning and sometimes, usually at night, I read something before going to bed. That's a pretty good solution
Okay.
or thing for helping me fall immediately asleep if I open up a book. So reading at night. And then lastly, took Civilization, that PlayStation 3 Civilization, and put it in the trash. And instead of actually doing that in some of my spare time, I am committed to being more connected with Colleen and just being more present. And it wasn't a problem. I wasn't playing too much, but the time I was playing, there was no interaction with really anyone. So instead, last night we played a board game, which was, I love board games. I love games. So and she does too. We played a board game called Quicks, and it's just a fun game. And lastly, working out more. I mentioned last week that I was doing the cash value insurance. I don't have a specific update on that because still doing the paperwork and things, but did take a physical for it earlier this week, and I don't remember what my blood pressure was, but it was very good, and my pulse was 54, and so it all checked out good. And so I bring that up just because I've been working out more, been mixing in weights and running. Yesterday I ran a mile, and then did sprints, and then did another mile after that. And then one suggestion I have is, if you have a lot of calls, then find a way where you can exercise during the calls. Kind of unusual to do at first, but what I do mostly now is when I have a call, I'll do it on my treadmill, and I'll have just a piece of a wood that I put over my my treadmill, and I can prop my laptop on top of that, so I can walk while I'm doing my calls. And I did that yesterday. I had 6-7 hours worth of calls on different things yesterday. I'm back to back to back to back to back to back, and I would be afterwards very upset and just cranky if I was sitting down doing all the calls because I'm not getting exercise.
Mm-hmm.
But from that, I actually had more energy on the calls, and afterwards it was pretty good. So I'm finding a way to incorporate exercise into the day-to-day stuff is helpful. So I mentioned all this not to say, hey, this is all the cool stuff I'm doing. It's just little changes that I'm making that will make incremental differences over time, and then or incremental differences initially, and then over time will make larger differences. And some of these are forever skills like CPR, so I acquired a forever skill, and some of these are more temporary, and you better keep it up, buddy, and that's working out and other things.
Yeah, there's a couple things to add. If you want a good board game recommendation, I recommend Settlers of Catan.
I don't think she'd dig that, but I would.
Yeah, me and Marcelo play Settlers of Catan all the time. And then the work, the incorporating and working out into your kind of daily, I guess, work life. It's just simple. Whenever I'm on the phone, I just put on my headphones and kind of pace around the house, and that's how I get my walking in. And I actually got so bad at working out that I just put a gym in my garage, and I literally have to, like, I've got no excuse because we were getting up at so early in the morning to go to the gym. And we were going at 5 a.m. and that was just too intense for me. So now I can just go in my garage and pump some iron whenever I want. So just kind of figuring out your weak points and then finding a solution to them.
That's awesome. Yep. Yeah, that's the way to do it. We all got weak points. or areas that we can hone. So it's just being identifying where they are and keeping on improving. And that's the key, incremental improvement. All right, let's wrap it up.
All right, so we got the best ever conference 2019 is officially live.
Oh, that's right.
So you guys can buy your ticket at the besteverconference.com. Right now,
it has been live for quite some time, but we are starting to put in the guests who are speaking at the conference, and at besteverconference.com, the tickets today will be a lot cheaper than they are at the end of the year. So I think they're $7.99 now, but at the end of the year, they're going to go to $1,000 a ticket. So if you're planning on going to Denver and hanging out and attending the 2-day conference late February, then I suggest you get your tickets between now and the end of the year.
Exactly. That's besteverconference.com. And then lastly, we're going to do the book review of the week. So make sure if you've purchased the Best Ever Apartment Syndication book, you leave a review on Amazon, take a screenshot, and send it to info@joefairless, and we will send you a whole bunch of free apartment syndication goodies. This week's review is from Dallas Investor, and they said, admittedly, I have not finished the book. I am through chapter 3. However, it is more than enough sample size to draw conclusions. First of all, I can't wait to finish it. That is the most powerful endorsement that I can provide. It is very well written. Fairless and Hicks pack a tremendous amount of knowledge into each chapter and page, yet present it in a very simple, intuitive, and easy to digest format. If you are a beginning investor, it is not only highly recommended, but should be considered a must read.
Thank you so much for that feedback and taking time to do the review. Really appreciate it. And Best Ever listeners, thanks for hanging out with us. Hope you got a lot of value from today's conversation. Hope you have the best ever day, and we'll talk to you tomorrow.